But when you're an institution and you're managing $1 billion or even 100 million of exposure, you got to think of a different product. And so in our world, what worries us the most is counterparty risk. Once again, I come back from the bond world. I've lived through some pretty dire times, especially in structured credit and structured products, most notably CDS and other types of instruments like that, where counterparty risk, you thought AIG or Lehman or Bear Stearns were great counterparties. That was dead wrong. And so we take a view that if you're going to buy protection, whoever is funding that protection, whoever is selling it to you, they better put up that money and you better know that it's there. And it will sit with somebody solid like US Bank, who's our custodian. They manage all the cash flows in our hedge. Once again, that hedge fund that's selling that protection and basically funding it, he's got to put his money into something solid. So in our structure, what we've done is we've taken that collateral. It has to be posted at the start of the structure, and it's invested in treasuries. And it's just 3-month treasury bills. And he will earn interest on those treasury T-bills through the tenor of the structure. You've got one side, think about a treasury that wants to offset some risk. So that investor is going to buy what we call a collateralized put obligation. Think about it as a put option. And he's going to pay a certain amount of premium, just as you would for any put option. And that's going to go to the other side, which is the hedge fund. The hedge fund will take whatever that difference is from the strike price all the way down to zero, depending on how they structure it, because this is a bespoke type thing. That hedge fund will collateralize the whole thing. It sits in treasury bills for the 1 year or 2 years, for however long they put it on, such that if that option, if it comes into the money, then whoever the holder is, they can exercise it at any time. But what's very different about this approach from OTC options or IBIT puts and calls is pretty big, because the yield bearing treasuries gives a better pricing dynamic to this. So the economics work better for the hedge fund selling the risk. You don't have that in IBIT puts and calls, and certainly OTC options, you have no darn idea who your counterparty is, which is a very scary place to be. And each one of these securities, because these are issued as private placement securities, not derivatives, although the characteristics are somewhat similar, but they're not, because these are fully collateralized. All that stuff it's customized, it's bespoke. So it's really made for that savvy treasury management person. Whereas if you look at OTC options or IBIT options, you've got basically standardized strikes and expiries. Those are the characteristics of this that make it a very different animal from currently what's out there. But it's a traditional finance structure that Wall Street firms and people are really familiar with. It's just not offered by anybody else yet. So when you go to Baskin Robbins, there's a ton of great new flavors. We're just a new flavor of ice cream. And so that's our real approach to it. And we really do feel like we're filling a gap that exists that no one's filling yet.